Hello everyone, welcome back to my YouTube channel and I hope all of you are doing great. So in today's video, we'll be looking at how to trade commodities. So this is not going to be a typical video where I explain you the history about the commodities, but this is going to be a video about how what are the different ways that you can trade commodities in the Indian market and diversify your portfolio. Right. So let's get started with the video. So standard disclaimer, I am not a SEBI registered analyst and any stock discussed in this video is not a buy or sell recommendation. Please consult your financial advisor before taking any trade or making any investment. So let's get started. So what is a commodity? Right. So a commodity is a tangible good that can be bought and sold or exchanged for the product of similar value. Right. So what are the properties? Properties or and sold by different companies or manufacturers and all of these. So like, your coal, gold, corn, sugarcane, wheat, all these are just commodities that can be traded, that can be bought and sold, right? So how commodity trading works, right? So that is the most important question, how commodity trading works. So it all starts when you buy a futures contract. So one thing that you need to understand about the commodities is that while trading commodities, it can be only done through futures, which is a leveraged asset. And what I mean by that is a leveraged asset is somewhere, let's say, you want to buy something for 1 lakh, but you have only 20,000 available with you, right? So what you can do is you can give your own 20,000, which is called a margin, and the rest of the 80,000 will be provided by a broker, right? So it all starts when you buy a futures contract of any commodity being traded on the exchange, right? So these commodities are also traded on the exchange, like the NSE and the BSE exchange that we have for the stocks. So here you do not pay the entire amount of the commodity, but only a fixed percentage of the cost, which is known as the margin, as I explained earlier. You could sell this contract anytime before expiry of it. So futures contract have a expiry, right? So the expiry could be 1 month, 2 months, and so on, right? Only if you sell the course contract before it expires, you don't have to worry about the really buying the gold, right? For example, let's take an example of gold, right? So you bought the futures of a let's say contract of 1 lot of gold, which is equal to, depends if you're trading the gold, so it is equal to, I think so, 1 kg of gold, right? We can check that on a website like Zerotha, where you have different commodities. For example, let's check the gold, right? So the lot size of 1 kg, right? So margin required is somewhere around 7 lakh. So I'll come to this part a bit later as well, right? So coming back to the main part, right? So you don't have to worry about that. You have to buy the physical gold. You can just sell the contract on the exchange and be done with it. Plus, when you're doing these things to the discount broker, you don't have to worry about the physical delivery of the commodities, because the broker will itself sell that particular contract before the expiry, right? So continuing, so as stock prices are quoted on daily basis in the stock market, in the same manner, the commodity future prices are quoted on the commodity exchanges. Just like we have a fluctuation in the stock prices every single day, right? Similarly, we have the fluctuation of the prices in the commodity market as well on the commodity exchanges, right? So just like in equity market, we have exchanges like NSE, BSE, where the shares are traded. Similarly, we have MCX and NCDEX, right? Where the commodities are traded. So what is the difference between the MCX and NCDEX is that the focus, first of all, focus. The MCX includes industrial metals, precious metal, oil futures, right? So if you want to trade something like, let's say, gold, silver, aluminium, crude oil, or something like that, those precious metals or normal metals, those can be done through your multi-commodity exchange, which is MCX, right? And NCDX has a clear leadership in the agriculture trading segment. If you want to trade something like your cereal and pulses, maize, crops, different crops, right? Barley, wheat, chana, moong, and paddy, different kind of things, right? Like your sugar, like soft commodities as well, or maybe the fibers, which are like cotton and different seeds, or maybe pepper, jeera, coriander, turmeric, like spices. So these can be done through the NCDEX, right? So we won't be going deep into like how to exactly trade these commodities, right? So will be brushing upon how to trade different commodities, because how you can diversify your own portfolio, right, from the equity to something else, right? So different ways to trade commodities, right? So trading commodities directly on MCX and CDX, right? through a broker. Here you'll have to remember that it is done through futures and options only and is a leveraged asset, right? So it can be done through futures and options. And the second thing that you can do is trading ETFs. You can also buy and sell the ETF based on the different commodities like gold and silver. You must have heard the name of the gold bees or the silver bees. Let's say you don't want to trade the commodities directly. You don't want to trade through the futures and options and you're not comfortable with that. What you can do is you can buy the ETF of those commodities like the gold bees or the silver bees, because they will follow the movement of the commodity itself, right? And the third way is, which is also not very popular, but and it's a bit different also, like trading the underlying stocks. So commodities with the companies which are which produce those particular commodities and are related to, like if you want to trade zinc, let's say the zinc prices are increasing, so who will benefit from that? Which company will benefit from that? The company that produces zinc, right? So like the Hindustan Zinc, Hindustan Copper, Hindalco, Vedanta, Tata Steel, etc. Because the earnings are linked to the underlying commodity prices. So when the commodity prices are going up, the producer of these goods will definitely make a lot of money, right? So another thing you can do is, like, if you want to check how to trade the commodities, like if you want to go in directly, so there are smaller version of this is also available. Let's say you want to trade the gold, right? So gold is available to trade in four different types, right? So the first one is gold, where the lot size is based on 1 kg, where the margin requirement is 7 lakh and 2364 from the current basis, right? So this is the margin required, the amount that you need in your account. So here the difference will come in the profit and loss statement, let's say, right? So because there are different sizes of gold, let's say you want to trade a smaller quantity, like the gold guinea, right? So the margin requirement is just 5795, right? Or you want to trade something a bit larger but smaller than the overall size of the gold, so that is the gold mini is available, where the margin requirement is 71856. Or the gold petal, which is larger than guinea, like even smaller than guinea, where the margin requirement is just 705 rupees. The difference comes in the PNL, right? So just to give you an example here, right? So this is the brokerage calculator, and here you can also kind of guess the PNL also. So let's say you traded the one lot of gold, which is of this one, which has a lot size of 1 kg, right? So that is like you're buying of 70 lakh or something around that level, right? So let's say you bought the gold. So because you can check the gold prices here as well, you can just go to trading view, and what you can do is just search gold futures, right? So you'll get the futures prices on MCX, right? So again, you'll use the same logic of price action analysis here as well, right? So if you look at, just let's suppose we bought the gold at this particular price where the breakout is happening, right? So you can just check it. Let's say you bought the gold at 76,340 and sold at 77,700, and you did it with one lot. The profit you made was somewhere around 1,34,000, right? So this is for the gold, which has a lot size of 1 kg, versus you did it in case of mini, right? You bought at the same price, sold at the same price, one lot, and your profit here is 13,420, because the overall margin requirement was less, overall quantity that was traded was less, right? So if you want to try it, like if you see, if you want to trade silver, so silver micro is actually very popular. Silver micro is like around lot size of 1 kg, and the margin requirement is like 16,841, right? So what you can do, you can simply check the price of the silver futures, right? So let's say you were able to buy it somewhere around 93,513, right? So 93,513, let's just select silver micro, right? So 96,000, and the price was 96,000, sorry, 93,340, okay, 93,340, and you sold it. Let's say you just traded a one lot and you sold it somewhere around 97,800, okay? So 97,800, right? So the profit made was 4,396. But if you take the similar quantities and you trade it in the silver, which is the largest quantity of that particular silver, right? And you bought it, sold at the same price. Just I'm just making assumptions here. You can just verify these, right? And you sold it at the same level. Let's suppose the amount you will be making is 1,13,000, because I'm just telling you about the difference in the lot sizes, because that also increases your risk as well. Because just imagine you have a portfolio of let's say a 10 lakh, and you're trading gold with the full quantity, because the margin requirement is 7 lakh, but the whole quantity that it is being traded on is somewhere around 70 lakh, right? So I find a safer way to play these is through the ETFs, like your gold piece. Let's suppose gold. Let's take a look at the gold piece, right? So this will also follow the price of the underlying gold, which is traded on the MCX, right? And it will move in a similar manner. There will be a little bit of tracking error, but what the benefit here is that the volatility won't be that much, and you can go in with a much higher quantity, and there will be no leverage as well. Plus, you can trade other stock also by pledging these gold bees and these things, right? And plus, the gold on MCX will be following the price of the international gold, that is the gold on silver, like gold and silver. Plus, the market timings are very different for the equity market and the commodity market. So it is for like it trades around for 15 hours, right? Plus, the uh, international commodity market is being traded 24/7, right? So like whenever the US market opens around 7 o'clock, I think so, 7 or 8. So there comes a lot of volatility in case of silver and gold in these commodities, right? So that is what I have observed. So you'll have to be careful about that as well. So plus many people do the intraday. Many people use these as hedging for the equity portfolio and a bit for diversification as well. So that is it, guys, for today's video, and I hope you enjoyed and you learned something new. Don't forget to like, subscribe, and share. Goodbye. Take care.